Renovation Rundown. How you doing, folks? I'm Sean Thompson. Thanks for clicking in. We got a really fun one for you today. I got to tell you, this is going to be a really good time. My name's Sean Thompson. You can reach me at www. I don't know why I say that anymore. It's ridiculous. Renoloans.net. Does that make me old? Does that make me old saying it like that? Using the three W's up front? Don't answer that question, by the way. But we got a great show for you. My guest coming up a bit is going to be really, really fun. What I did was, just to jump right into it, is I like to back out, zoom out, if you will, back to 10,000 feet, and really ask myself this question every so often. I think it keeps us healthy. And the question I'm going to ask here is renovation lending, makeover marketing, a market need? We really need to care about this, right? And so I went into it. I did kind of a deep dive on this just to ask myself, do we really need to care about this, right? And what you're going to see is shocking, right? So I'm going to walk you through this really, really quickly, right? Not to bury the lead, but I'll start out with how many buyers are putting little down, right? Because that's the first question. How many buyers are putting little down? Well, according to the National Association of Realtors, 45% of home buyers, 55% of first-time home buyers put down less than 10%, roughly about 7% being the average. Okay, how many of them are leaving the closing table with no money? They are exhausting their savings on down payment and closing costs, and then they have no money left. Well, look at this. This I was shocked to find out. About 30-40% of first-time buyers are leaving the table with less than 2 months mortgage reserves, less than 2 months of the mortgage payment, right? We call reserves, right? That's a huge number. It's an even bigger number when you think about buyers overall. 20 to 30% of buyers overall are leaving the closing table with rabbit ears, right? Doesn't happen so much with repeat buyers, but think about it. That's a lot of people who exhaust their savings on down payment and closing costs, and then they don't have the $50,000, $60,000 that Chip and Joanna told them they needed for the kitchen, right? Okay, great. Let's keep going with this concept, right? What percentage of the homes in this group will be presented, what percentage of the homes that this group will be presented with need some kind of repair, customization, or upgrade, right? Check this out. And I'm using the Northeast because it's the oldest part of the country, but it flares out, across the country when you do the numbers as well, too. Maybe not as dramatic, but, on this chart, if you look at the left side, those three bars on the left side, that's 69% of the housing stock in New York, New Jersey, PA that was built pre-1980. That's huge. It's almost 70% of all the homes on the market was built pre-1980. It's 46 years ago, right? 1980 is 46 years ago. My God. And then what percentage of those homes will need some kind of customization or repair or aren't in fact move-in ready? So a couple of months ago, I did a show where I showed you this Realtor.com, ad, and whether or not they meant it as tongue-in-cheek or not, the point landed pretty hard, right? Which was, and this was a heat map of the states where move-in ready homes were not really move-in ready homes, right? The redder the state, the more opportunity you had to run into this. Now they since changed it. You can still go find this article, but it's going to be called this now. I think they softened, the lead a little bit, where buyers face the highest risk of buying a lemon. Nevertheless, in the Northeast, you do see a lot of those mistakes. So these are homes built as move-in ready that aren't, right? You get in, some sort of deferred maintenance happens or some sort of issue. The house is not really move-in ready. It's just being built as such, right? And then you might ask yourself, well, why would they consider those homes? I don't have any money left. I'm exhausting my savings and down payment and closing costs, right? I run the risk of coming into a home that's going to need deferred maintenance anyway. So why would you consider those homes? Well, it's all about money, right? So this article was put out just late last year that fixer-uppers are priced 54% lower than the median single-family home in the United States. All right, so that's a big reason. There you go. There's your number one reason. And then I get some pros that will tell me, why not let the flippers do their thing, and the housing stock, will get better because they'll be the ones fixing it, and the buyers don't have to take on that risk, and we're hearing in the zeitgeist today, of the housing industry, that's probably not a good idea either, right? Flippers, particularly your mom and pop flippers that are doing their first 5 or 6 or 7 or even 10, when they run into issues, right? They cut corners. You're paying for those flippers' mistakes. They're keeping the profit on top. There's still deferred maintenance that exists. That's why the term slapping lipstick on a pig exists, right? Is because a lot of times what you're inheriting in this article here, we bought a flipped house, now it's falling apart. The telltale signs we wish we hadn't missed is a peer, into what happens when you buy from a flipper and you don't do that work yourself. Not to mention you don't get all the repairs that you actually want, right? You get the repairs that they cut corners to give you, hoping that you'll like. Double fingers crossed, right? So kind of what did I cover here, right? Remember, the whole point here was to zoom out and go, is there in fact a market need for this, right? And the answer is yes, a resounding yes. We learned that buyers are cash constrained, for the repairs. Inventory is old, right? 69%, were built pre-1980. 69% were built when DeLoreans were made, right? There's a Back to the Future reference, by the way. Move-in ready is overpriced. There's still deferred maintenance. Flips tend to bake in someone else's profit mistakes and corner cutting, right? Fact, right? So makeover transactions aren't the problem. To my point here, they are the opportunity. They are the solution, right? So there you go. Before we get to my guest, check this out. By the way, a lot of what we talk about on this show comes right from my book, The Renovation Lending Playbook. It's a practical guide for buyers and agents who want to turn fixer-uppers into smart, affordable purchases. No hype, just the process. Just search Sean Thompson Renovation on Amazon or click the link below. Also, do me a huge favor and hit that like button, share it with a friend, and make sure you subscribe so you don't miss out on the next one. Every share helps us save more home buyers from needlessly overpaying, and that's what this show is all about. Now back to the content. So, like I said, in previous episodes, I really wanted to get some more guests on, right? And for me, there is no greater guest than the one I'm going to show you today. I think he's such a great guy and such an industry, a knowledgeable person on the subject, right? And I'm going to go ahead and introduce Jim Bopp, right? Vice President, National Renovation Lending at Planet Home Loans, right? Here with him. Jim's been in the reno space for a long, long time. I think I can refer to him as the corridor of all things renovation lending, particularly in the correspondent space, right? So not just that, but like super active and government advocacy and NBA and overall huge voice for all consumer products pertaining to renovation lending. Jim, welcome to the Renovation Run-Down. Good to see you.
Sean, it's good to be here. I'm glad we finally pulled this thing together.
Me too, man. So
I think we've only been talking about this since about 2019, Sean.
Yeah, I know. And so I'll jump right in. Like, what did you think of my opening here?
Sean, it's I saw my first 203K in 1986, and apparently I didn't have the common sense to run the other way. And, to be quite honest with you, it's made for a great career, a passionate career, and something I truly believe in. Everything you laid out in your slides and your presentation, I pretty much agree with 100%. Fascinating information to be presented. Being a national renovation person who does a lot of business with correspondents, I'm also involved in Planet's retail channel and driving renovation loans there. Looking at that heat map in particular, and we didn't get to talk about it yet, but most people don't realize that 67% of all the 203Ks in the country are done pretty much from Baltimore to Boston. So when you show that heat map of, I forget what you called them, but where houses have problems that are supposedly move-in ready, that doesn't surprise me because let's face it.
Here, I'll pull it back up.
The collateral's pretty old on the East Coast, right?
Yeah.
And on the West Coast, it's funny, we watch this here at Planet. West of the Mississippi, for some reason, there's not a lot of 203Ks done, but that's not to say there's not a lot of renovation done. So, we don't want to focus too much just on 203K because, as you know, there is a plethora of products for people to choose from: Fannie Mae Homestyle, Freddie Mac Choice, VA alterations and repair, and so on and so forth. So, all the statistics you're laying out for is there a market and where is that market? I think you're dead on.
Yeah, I like to back up every now and again and assess whether or not what I'm selling is viable, right? You know, I'll also say to you this, there was, I don't know if you got a chance to see this, but I'll pull it up here. There was the CFA, the Consumer Federation of America is what they're called, which is a nonprofit collection of about 250 consumer organizations, which started in 1968, right? Just released a report on the 203K. So I didn't, it came out in January and I didn't notice it. So hat tip to our guy, Matt Picaro, the 203K Way guy, right? If you don't know Matt, go ahead and look up 203K Way, folks. Trust me, you'll have a good time. Matt sent me this the other day and said, "What do you think of this?" And I actually hadn't seen it. Here, let me pull it up. Have you read this, Jim?
Oh, 100%. I've read it. It was sent to me immediately. It's I read through it, and you mentioned already that I do a lot of policy work with the MBA. I'm actively involved in their FHA 203K working group from a policy standpoint. And when we say that again, we're also talking to Fannie Mae, Freddie Mac, and others about renovation products all the time, be it VA alterations and repair, USDA, so on and so forth. And, quite frankly, there's a lot of conversation at the agency level. Do we still need 203K consultants? And, I'm sure you have a lot of opinions on it. Like everything in this business, there's good ones, there's bad ones. Like there's good appraisers, bad appraisers,
Well, I
good
want
loan
to I want
officers.
to get to that. I want to get to that in just a second because
But
and what you're saying is great. Just let me tease this a little bit, and on the other side of this, we can kind of get to that because they say some of the same things that you and I are saying in a report, right? So I guess the conclusion of it, if I had to summarize it, was 203K is powerful concept but poorly executed program. Okay, no argument there, right? Complexity or lack of infrastructure or limited industry adoption have reduced usage dramatically. Okay, I sort of correspond this with, and I'm a little biased because I spent 17 years there, but I correspond the drop in overall national production with Wells Fargo's exit from the renovation lending platform, because we were doing just the grand majority, of the renovation in the country until they decided not to do it. Okay, great. With reforms, it could be a major tool for solving housing shortage and improvement aging homes, they say. Now, the suggested reforms, and this is where I want your opinion, right, were a bit goofy to me, right? So increase awareness. Okay, great. Copernicus, nothing new there, right? Expand the HUD consultant network, which you were just alluding to a minute ago, right?
yep.
And 3, they gave 4 suggestions, right? The third one was link repair grants to 203K financing. All right, I'm going off the rails there a little bit, but all right, I thought that was weird. This last one's really going to throw you. At the tail end, expand the HUD mortgagor program, right? I had to look that one up because I forgot it even existed, right? And here's what it is. I quote. This is from the article. This congressionally authorized program allows qualified nonprofit and governmental entities to take out FHA renovation loans, fix up the properties, and let borrowers, quote unquote, assume FHA loans on updated homes. In other words, let's have the taxpayer foot the bill to allow government-approved nonprofits to fix them and control who buys them. Nothing could go wrong there on that, right? Right? And you don't have to agree with me. That's just the way I look at it.
So I will agree with you in regards to, I think, what made Wells Fargo great and what could make this program great. And I've written pieces on this, thought leadership pieces on this. What we need is the mortgage banking, senior management, and ownership at the IMB level, and the banks and credit unions to commit to getting back involved in these loan programs. I can tell you from being a correspondent person, especially, if you come into a company through a branch manager or a loan officer who wants the program, you're kind of doomed out of the box unless you have senior management's agreement to learn these programs, understand these programs, and support them operationally. And I think when you had somebody exit as big as Wells Fargo, and I used to work at M&T, and I can talk about nonprofit renovation loans because I did a ton of them when I was with M&T. Even they have pulled out of the correspondent renovation space. We need to have senior management of companies say, you know what, as an industry, we need to help fix this inventory problem. And quite frankly, we're not going to make up, and I don't know, if you argue over the number, is it 1.5 million or is it 4.7 million homes we're short? We're never going to make it up with new construction. So I know in your slides you were talking about houses that are older than 1980. 1980 is an old house. You probably had at least one. Maybe you're on your second roof replacement. Maybe your
Yeah,
second.
I say it all the
Maybe
time.
your
I
second
bought
furnace. Right?
Yeah, I bought my first house in '97, right? And carpet was totally acceptable. Formica countertops were totally acceptable, right? And I think, it's hardwood floor or bust right now and illegal to sell a house without a granite countertop in it in 2026. So, things have changed quite a bit, right? From a house built in 1980.
You and I bought the same house. And this house has been going through stem to stern. It's got granite, used to have formica, used to have carpet, now it has all hardwood all throughout it.
Right.
It's, and today you're going to get the snap on vinyl flooring, right? You're going to get the vinyl plank snap flooring, which everyone's using, including Fannie Mae and Freddie Mac when they do one of their go throughs on back when they used to have the home path properties at Fannie Mae.
Mm-hmm. Mm-hmm.
You used to see the brand new carpet all vacuumed up on the ones they were selling move-in ready. And today you see that vinyl plank snap-in flooring everywhere throughout the house because they have a pallet that they lay down inside of these houses to get them sold. But yes, you're 100% correct. So on the mortgage banking industry commitment, I think I would challenge senior management everywhere, and I don't have that problem here at Planet. From our CEO, Mike Dubeck, through John Bosley, through my boss, and every senior manager here at Planet, we're committed to renovation lending. We also have a fix and flip division called Planet Renovation Capital. So this is who we are. This is what we do. We understand it. We have the tools. We have the process. We've invested the money to grow the business. And I commented out on LinkedIn over the weekend, somebody, saying, this program's dying. We've been growing it by double digits here every year since 2020. And that's because we focus on it and we work on it. In terms of the nonprofits, the issue with the nonprofits is there's not a viable secondary market for it. It is a program that people could do today. There's no need. The guidelines are there. You can do them. I would say that I think many lenders would be challenged to underwrite a nonprofit renovation loan. And I'm not here to say Planet would be in that creating that secondary market, but there is a way to do them. But the nonprofits also have to agree to go ahead and learn the program and give everybody what they need to do it. So it's a very complex underwrite. I'm not sure your average, no disparaging comments here to your average residential underwriter, but you almost need a commercial loan underwriting talent in your shop because you're talking about complex schedules of real estate owned, and you're talking about having to evaluate restricted and unrestricted cash flows on these nonprofits. So could you do it? Yes. Who would embrace it? Who would create that secondary market? That would be a heavier lift than really just everybody committing to help consumers buy properties. And I know you had a few slides on the consumers and bidding in on properties and buying properties that probably still need work. But
Well,
really,
look, I mean, and I hear you. You're way more generous than I am. I think the consumer is a little fed up with the nonprofit, quote unquote, generally speaking, branding, today. There's not a lot of confidence in that, so, the last thing I want is is programs that, feed people's, nonprofit owners willingness to buy Mercedes and large houses, right? So I think that confidence can be worked on. And I'd rather see the consumer get good at it, because it seems like you're usurping the consumer's ability to get good at their own financial awareness. Buy the house, get a great contractor, pick out what you want the way you want it, finance the two numbers combined, right? And you get to keep the equity, right? So what's more pure than that, right? Getting an investor to do it first? No. Getting a nonprofit to do it first on the taxpayer dime, supposedly? No, right? So let's teach the consumer to do this. Let's teach the consumer
You have
to
a
do
great
this.
point there, because it's one of the points I'm making through the MBA. There's an immediate role the nonprofits could do in 2 seconds. And I've talked to Fannie about it, and Freddie, and to a certain extent FHA. Mandatory, make every home buyer education program credits, be it for the home, the home ready, home style, or the home possible Freddie choice. Every nonprofit housing counseling program should have one module, one chapter, one segment on how to use renovation loans to buy the homes. They could do that today in 2 seconds. I'm sure there's a loan officer in every city near every nonprofit who would love to come in and talk to first-time home buyers that are in those courses, either to get a down payment assistance program or some other thing, to learn about how to do renovation loans and the process and which properties they can go get. Because I know you also talk about the fact that, if a consumer can buy a house that's in need of repair, 9 out of 10 times they're going to get a discounted price. And if they do a conservative budget with a good consultant, good contractor, they're probably going to have instant equity. First of all, they're going to win a bid and be able to get a house to begin with.
Well,
But
you and I have
second
been
of all,
involved in thousands of those transactions for sure.
tons of them. So, on a personal level, I have 7 either brothers, sisters, nieces, and nephews that have done 203Ks. One of my nephews bought a bank foreclosure.
Wait. What? You got
7 of
seven
my family
brothers and
members
sisters, and then
well, I
they've
have
all
7
done two or
brothers
three
and
Ks?
sisters. Yeah, they all have kids. Yeah.
Oh, they're all okay. All right.
And my brother Dan is a 203K consultant. So, it's kind of the New York
I would
way to
expect
kind of
nothing less from a Bopp
put
family
together your
member.
posse, right? You got to have your
Yes.
posse. But, in all seriousness, if mortgage lenders, banks, and credit unions would get out to these nonprofits and say, we want to do home buyer education, that's your best role. And a matter of fact, I also proponent, I just did this morning with somebody. I said, you need to bring a 203K consultant to a real estate office or to a nonprofit to do the presentations with you. Because, and this pulls back full circle to your awareness. And I do agree with you. Why put a middleman in there? Let's just get right to the consumer and teach them how to do it right and get them in the right house for the right reasons. The only theory behind the nonprofit, which the other discussion is out there, bring back the investor, okay, is that the average first-time homebuyer gets overwhelmed and can't pull off the home improvement project, and that the borrower will
I do agree with that.
eventually
If I
get an
had to
assumable
rewrite,
FHA loan.
I do agree with that. If I had to rewrite those suggestions, I kind of have a thought about making HUD consultants somewhat optional, right? Because in some markets, you're limiting your ability. Like if I want to do a K in Montana, they got one HUD consultant for the whole state, right? So if I make that optional, do some other way for establishing the feasibility on that project, and allow that person to do that inside of an FHA qualification realm, right? Then I open up, more products. Not that I'm downplaying the need or the value of a HUD consultant at all. We're just addressing the fact that there's not many of them in certain parts of the country, right? And then lastly, I remember the days where there was no upfront MIP on a 203K. Bring that back.
Hey, look,
right?
You are at our, we haven't talked one-on-one in a long time, but we're on the same exact page. Either reduce or eliminate the upfront MIP or the monthly MIP, or get rid of life of loan MIP. If you're really going to go after renovation under a duty to serve, affordable housing, CRA type product, which is the genesis, which the original reason the 203K was invented was to revitalize neighborhood. It is historically HUD's premier CRA lending program, right? If you really want to incentivize that, then make it more competitive with conventional programs. Get rid of the MI or not make it life alone. Something.
Hey, look, if we're gonna care about the entry level buyer, and the zeitgeist of 2026 is affordability and caring about, first time home buyers, and why are they not buying their first house until they're 35, 36? If you're gonna care, put your money where the mouth is, right? The MIP fund account is running at a surplus now. I remember back in the day when the MIP was at a negative, right? So the mortgage insurance premiums,
below the 2%. Yes, it was below the.
So mortgage insurance premiums collected are running at a surplus right now. Let's give entry level buyers an advantage by removing the MIP, the upfront. I like your thought about giving some degree of discount on the monthly version too, because that's important. But go ahead, let's commit. If we're going to care about entry level buyers, let's care about entry level buyers and give them a vehicle that they can actually use. Jim Bopp, this has been incredible with you. We did like 30 minutes that fast, man. So tell people where they could find you and kind of who your perfect customer is.
So I'm at Planet Home Lending, PHL. So it's JBOPP, like bop somebody on the head, at planethomelending.com. And from a correspondence standpoint, my perfect client or partner or seller is somebody who wants to either grow or start their renovation program. We have a cascading model of you can start out non-delegated underwriting, then you can go to delegated underwriting with a pre-closing review. And we've taken many lenders from doing one a month or one every other month to doing 8, 9, 10 a month. So we can help somebody grow their program. It could be a bank or a credit union or an independent mortgage banker. We're involved in the retail side. And like I said, we have Planet Renovation Capital, which is a fix and flip division. And, we're kind of, I think it was back, I think it was Fleet. I was with Fleet for some period of time. Wells probably said the same thing. We'd like to be your renovation lender, no matter what channel you come through or how you do it. And as you know, Sean, I'm a theory of abundance guy. I give back to the industry. There's plenty for all of us. We just need to message it right. And we need to all work on the mechanics of it. And maybe a future segment, you and I can dip into how technology and AI might be some of that answer to the rural borrower or to streamlining the process, because I think the limited 203K took a step in the right direction by being able to go to 75,000 escrow. So in your rural markets, you can at least get more work done, right? You can get about 30,000 more work done than you could during the old limited rules. So, the good news for all of us, Sean, just like you and me, we promote it. All the agencies want to do it better. So let's keep the conversation going, and let's see what we can do before you and I retire.
Well, front and center, my man. You're doing God's work, and I love it. Keep it up. The people who find you can really use what you guys offer, and I think you're a great guy. So let's catch up soon, right? It was good. It was good spending time with you. Folks, Jim Bopp. Thanks, Jim. We'll talk to you soon.
Thanks a lot, Sean. Appreciate the opportunity to spread the good word.
You got it. Thanks.
Have a
Folks,
good day.
there you have it. Another renovation rundown. You know what? Do me a favor. Like us on YouTube and Facebook, and find us on Instagram at FHA203K. If you like, I'm Sean Thompson. We'll see you guys soon. Go renovate something. Go. Get out of here. Bye.